The stock market truth right now. Hey everyone, it's Wolfgang. So right now, the Dow Jones Industrial Average in the stock market has fallen. It's down to 39,142 as of close of trading this past Friday. This is Sunday, April 20th. So we've all seen what's been going on with the stock market and the tariff issue, and then the reaction from countries responding to tariff announcements. The stock market has fallen. And this reverse wealth effect, right now it's being blamed for a decrease in consumer confidence, a decrease in consumer demand, and slowing economy. The things that are affected, when stocks fall, people feel a little bit poorer, right? If the stock market has fallen, it tends to affect anyone invested in stocks, and that's a lot of people. So people feel poor, they cut spending. It affects restaurants, it affects retail, and a lot of other parts of the economy. So the economic slowdown and a slowing economy can be triggered by stock market changes. The Great Depression was a good example of that. That was a severe drop in the stock market, and that lasted for a long time. So I've got some good news about corrections I'll get to in a couple of minutes here. But so right before airtime, the Dow Jones Industrial Average futures are down 300 points. So what are futures? Okay, so we know what stocks are. Stocks are a piece of a company that is publicly traded on the stock exchange. Futures are sort of a derivative investment. Futures contracts are traded to place bets on the direction of things, in this case, the direction of Dow Jones Industrial Average. So the Dow futures are down 300 points. What that means is traders in general are expecting the Dow Jones average to fall tomorrow morning, Monday morning, April 21st. So the futures are down, let's see here, the NASDAQ futures are down too. They're down about 200 points. So the Dow futures are down 300, the NASDAQ futures are down 200. So traders right now who are speculating in the futures market are expecting the stock market to fall again tomorrow. So how low can it go? So the market is probably going to drop. Futures are down. That doesn't necessarily mean the entire day will be a down day, but it's looking like the stock market will open lower. So we need to put this in perspective, okay? One of the main points that I wanted to make this video about was that where are we with the market? The market has corrected down over 12% from all-time highs, 12.5% thereabouts. The market has fallen that much, 12.5% from all-time highs from late last year. So a correction in the market is a drop of 10% to 20%. Somewhere between 10 and 20%, that's considered a correction. Right now, we're down about 12.5%, so we're in correction territory. A bear market would be if the market fell more than 20%. And in the Great Depression, that definitely happened. But right now, we're nowhere near that. We're only at a 12.5% correction. So let's put that in perspective. The market has fallen, the Dow Jones Industrial Average Index has fallen 5,930 points from all-time highs. It would need to fall another 3,131 points just to get to the cusp of a bear market. I don't think that's going to happen. I think the majority of the drop has already occurred. It started, the volatility and the drop started when all of a sudden the U.S. government started announcing changes to tariff policies. When that happens, countries that are affected then make a reaction, and they announce the reaction, what they're going to do to deal with the change. And then if the tariff changes announced by the U.S. government are changing, that affects the countries affected by those tariffs, who then alter their reactions. So this back and forth, it's sort of like a couple of boxers in the boxing ring throwing jabs. There's not a lot, nobody's landing a knockout blow. They're just counterpunching. They're just responding to each other. But that creates uncertainty. And the stock market generally does not like uncertainty. People tend to like to know where it's going. For example, let's say that you bought stocks, an S&P 500 index fund, or a Dow Jones index, say 8 months ago. Let's say you bought it then, and it has stayed roughly at that same level, okay? Let's say you bought it like last August. And let's say that right now it was trading at about the same level. You would say to yourself, okay, there's not a lot of volatility there. If I'm still at where I bought the S&P 500 index or the Dow index, and we're still there at that same level, the market has been fairly stable, right? So the market's down quite a bit from the all-time highs. If you own stocks, Most people know that there's a 9%, 10% annual average return over the long term. So people who are investors are not selling. They're not selling. Speculators are selling. Traders and speculators who are not in it for the long term tend to sell. They have a different motive for investing in stocks. Investors who are not close to retirement anyways know that the average annual return is 10%. That's pretty good. It's much better than you can get at a bank. So people know that if they buy and hold long term, the S&P 500 index in particular, the Dow Jones index also, or an ETF, a market ETF, you're going to do pretty well. Speculators, I'm not even going to go there because I've done that in the past. And generally, you win half the time, you lose half the time, you tend to not go anywhere. So unless you cheat or you trade on insider knowledge, like Congress people can do or do sometimes. So I said earlier, I've got something very positive to say about corrections because we're in a correction. The market has fallen 12.5%. So we're in correction territory. We're between 10 and 20%. We're closer to the 10% than the 20. So we're not even close to a bear market. Corrections last on average about 3 months, a little over 3 months, 3 months and 10 days thereabouts. So, but by the way, that doesn't mean individual stocks. That means the market. When the market corrects, the market usually corrects for a period of 3 months or so, and then it's out of correction phase. So if you are close to retirement, you should, this is not advice. You should consult with your financial advisor, okay? But if it were me, if I was close to retirement, I would say bonds and not stocks because of the volatility. So I want to say something about the volatility. The market, the volatility in the market is tracked by the VIX, the volatility index. Right now, today, Sunday, April 20th, the VIX is sitting at 30. When the volatility index hits 20 and starts climbing, that means we're seeing some volatility in the market. And it's this counterpunching between the U.S. government makes a tariff announcement, countries affected by that announcement, a counterpunch. And then the U.S. announces something else, and the affected countries counterpunch again. And it's back and forth. So the volatility index means if you buy into the market with an S&P 500 index fund or the Dow Jones fund, Dow 30 fund, it just means when the VIX is this high that you're going to see fluctuations. You should set your expectation. Now, remember when I said earlier that a stable market, if the market was not volatile, if it was stable, you might be able to say something like this. You might be able to say, last August, I bought the S&P 500, and right now, in early April or mid-April, the S&P 500 has roughly not really changed that much. It's been fairly stable. So, and this is the good news. This is the good news. And this is a little bit surprising for a lot of people because earlier I said the reverse wealth effect is starting to have an effect on the economy because people are feeling poorer. But here's the facts. This is the good news. The market right now is at the same level it was in August. So if you had bought into the market in August, you haven't lost anything. It's pretty much at the same level. And there's absolutely no reason for the reverse wealth effect if you bought in August. So a lot of people who are crying about the stock market dropping, if you can put yourself in a position back in August of last year, and you could say, I bought then, and we're still at the same level, there's nothing to cry about. So, and if you bought earlier than that, you still have gains. So, and more importantly, if you're not a speculator and you didn't sell, because a lot of people are not selling, you haven't lost any money. So if you had bought last August, we're right at the same level right now. The market has fallen. It did jump up, but it's fallen back to the same level it was back in August. If you didn't sell, like most people, only speculators have been selling, then you're in good shape. And so this reverse wealth effect shouldn't really affect you because if you think about where you were in August, think about your spending inclination, your desire to spend or your willingness to spend money. It should be no different now because the market is the same level. So that's the good news about the market. A lot of people are not aware of that. A lot of people are hearing this, okay, the market is in a correction, 12.5% down. Woe is me, I've lost money. Just a few months ago, the market was at the same level. So it's sort of a kind of a crybaby moment, maybe, but if you didn't sell, there's nothing to cry about because the cool thing is corrections last about 3 months. And the even cooler thing is the objective of the tariffs is to correct for trade imbalances. For example, China has a large trade imbalance in their favor with the United States. So after this tariff issue is behind us, right, once all the tariff counterpunching is over, you should expect the market to recover pretty nicely. And so a lot of people are actually buying. They wait for times like this during a correction to buy. They'll buy the S&P 500 when we have a correction. They'll buy the Dow Jones average, an index, a Dow 30 index in a correction. Because if you know that the correction lasts 3 months and it's pretty likely that within 3 months, all the tariff counterpunching, the U.S. announces a tariff change, affected countries react back and forth, that will be over. And the correction will be over. And if you've invested in the correction like a lot of people do, like we do, then you should expect a pretty decent recovery. Because I have to tell you that the best time that we found to invest historically, and this goes back for us a couple decades, has been in down markets. Having some dry powder, having some cash on the sidelines, and having the ability to buy when there's a nice correction like this, S&P 500 index fund, something safe. I'm not talking about individual stocks. I'm talking about buying the market, because we're in a market correction.'re not in an individual stock correction. We're in the whole market sort of correction. When you buy the whole market during a correction, within a few months, we're out of the correction. And in this case, the cool thing is the trade imbalances that have not been to the advantage of the U.S., some of those are going to be resolved and fixed, and that will bode well for the U.S. So let me make sure I didn't miss anything here. I did say that if you're close to retirement, this discussion is less relevant for you because personally, I don't, investing in stocks, even in a correction with what I've said, I think you're better off when you're closer to retirement to be in bonds. That's just my opinion. Again, I'm not an advisor. Consult your financial advisor. But if you have any questions about this, I'd be happy to answer any questions if you post in the comments. And I really want to thank everyone for watching. Best of luck in the market. Have a great day.